In this video, we're going to do a very brief walkthrough of Form 1040, which is basically the U.S. individual income tax return. And so I think it's helpful to kind of walk through this main form and some of the important schedules that are related, just to get a sense of what is actually happening when you file and pay your taxes. Walking through this form is kind of just for a more theoretical explanation, because you're most likely going to be using some kind of tax software to actually do the return and not actually printing this PDF out and doing it by hand. Most people will use the software. So before I kind of go through this form, let me just talk quickly about the software, because what the software will do is basically take all your information, ask you questions, give you kind of like an online format, and will automatically fill out this form 1040 as well as any needed schedules. It kind of figures out what you need based on, kind of the input that you put into the system. So let me kind of show you what that means by taking a look at the software first. Okay, so there's basically three main software packages available: Tax Act, TurboTax, and H&R Block. And so you can basically do some research on which one works for you best. It seems like TurboTax and H&R Block are typically kind of the more user-friendly versions. They're a little more expensive, and Tax Act is kind of the more clunky, but it's slightly less expensive of the three. So you can do your own research and see which one you think makes the most sense for you. But I would just warn you that once you start with one particular software, it's hard to switch, because it basically tracks your taxes over time, and it populates, if you're filing your 2021 taxes, it already has your 2020 taxes in there. And if there's carryover items, it automatically populates it, and it just populates, your personal information automatically. So it's a big time saver just to stick to the same app. So I would definitely do your research beforehand and make sure you're kind of happy with the software, because you may end up sticking with it for a number of years. Way back when, I just happened to use TaxAct, probably because it was the cheapest, and I'm kind of stuck with it. So I'm just giving you a little overview of how it's set up. So basically, it has these different tabs, and let's say, for example, this is the income tab. I received some alimony. You could click on this. You would put in, $5,000 or whatever it was. You would put in your date of separation, and it would basically automatically populate this number here. And then it would also fill out all the necessary forms. It would put this alimony in the correct spot in whatever schedule it needed to. So you don't need to know all the forms in the tax universe. You just basically have this software, which kind of provides a framework of what information you need, and then it will automatically figure out what forms you need. So in the same way, if you had deductions, you can see here that it helps you organize your deductions. So you can put, if you owned a home, you could click on this and put in however much taxes you paid in the year, and it will basically even decide for you whether you should use the standard or itemized deductions, which again, if you watch the video I did on taxes, you'll kind of know what that is. So you don't, again, I guess the point of why I'm showing this is because you don't actually need to know the tax form and like where to put each number. The software kind of organizes everything for you and then fills out the form automatically. So that's kind of what the value of the software is. And again, with tax credits, maybe you have some education tax credits, you can enter them here. Fuel tax credits. You will have to know what some of this stuff is, and may take kind of some research on your end. But most people have pretty simple taxes. They're not going to have American Opportunity Credit tax credits. This is kind of a real estate specific thing. So if you have pretty simple taxes, then most of these are going to be zero. The earned income tax credit, some people have that. So basically, it basically helps you organize all your information and then automatically populates the form. So now let's just go back to the form and see how these numbers, when you put them in the software, actually show up on the 1040 form. Because again, once you fill all this out, the output of this will be the actual tax forms because that's what you send to the IRS. And it won't actually be something you print out per se. Most people e-file. So through this software, it will automatically file your taxes, but it will basically end up populating a form that we're gonna like the 1040 form that we're gonna be looking at. Okay, so let's look at the form in a little more detail and see what pieces of information they take into account when calculating your taxes. So your filing status, single, married, filed jointly, married filing separately, head of household, qualifying widower. So these are going to matter because it's going to affect how much standard deduction you have and some other details in how the tax is calculated. So you should watch my video for a little more information on that on income tax. But you'll basically pick one of the filing statuses here based on your scenario in your situation. The 1040 form also has instructions that come with it, which also go into detail on kind of the criteria for each of these. So this is what the instructions look like. You can see that it has, definitions. It helps you kind of think about what you qualify, like, is your qualifying child your dependent? So it will help you figure out, if, it has kind of these criteria here that will help you determine different filing status, uh, who is a dependent, how to calculate things, and just general information on each line item of the 1040 form. So this is the instructions for 1040. Okay, so let's go back. So it's going to ask for your name, basic information about your name, your social security number, your spouse if you have one, their information, your home address. It now has this question about crypto. So this is kind of a new addition that if you look 10 years ago would not have been there. So there's probably going to be some additional form for this. Okay, it asks if you are someone's dependent or if your spouse is someone's dependent, and that's going to matter for kind of claiming your deductions and calculating your taxes, because the IRS doesn't want you to double dip where someone claims you as a dependent and they get a tax benefit for that, and yet you also don't take that into account in your taxes. So that's why they ask you this. If you have dependents, you also list them. So these are typically your children, or if there's someone elderly that you're taking care of are dependent on you, you can list them here because you get some tax benefit for that for each dependent. Okay, so once you've kind of filled out this information on the top, which is more kind of informational, now it gets into the actual calculation of your taxable income and the amount of tax you owe, and if you have any tax credits, all that kind of stuff. All those calculations are down here. So the first part of your income calculation is your wages, salaries, tips, and that typically is going to be reported on a W-2. So if you work at the library, for example, the library at the end of the year will issue you a W-2, which is a tax form which will list all the total income that you earned, how much tax that was withheld, and just other items that are important for filling out your taxes that your employer wants you to have so that you can fill out your taxes properly. So if you have more than one job, each employer will give you a W-2. Okay, then tax exempt interest and taxable interest and qualified dividends and ordinary dividends. So let's look at Schedule B because that kind of shows a little more detail about these items. So Schedule B basically is going to provide more detail and calculations for something that will feed into the 1040 form. So just skipping ahead here, you can see once you kind of do the calculations up here, which I'll talk about, you're going to enter the total here on form 1040. So you're going to do these calculations on this schedule, which is going to have details, and then you just take the number and then put it, and it tells you on line 5. So it's going to tell you, sorry, on line 3B. So in this part of the schedule B, you're going to calculate the dividends, and you're going to put it into 3B, which is going to be the dividends. And the same thing here, you're going to do some calculations on interest income where you list the name of the payers. So if you're collecting interest from a bunch of different people, you'll put who they are and then the amount of interest you collected. You add up, let's say they paid you $5,000, person 2, 2,000. So then you add these up, that's 7,000. Exclude interest on Series EE and I U.S. savings bond issued after 1989. So let's say these are just from people, so they're not government bonds that are tax exempt. So 0, and then this is 7,000. And so I would put this into 2B. So I would end up putting for taxable interest 7,000. So again, the tax software, you would have put, kind of your interest income and listed them out, and the software would populate Schedule B and 1040 with this number. It would do these calculations automatically within the software. Okay, and you would do the same thing with ordinary dividends. So dividends again are when you own a stock and the stock pays you a basically a return on your investment. So if you bought a stock for $100, maybe it has per year a $2 dividend, and so for every share of $100 you bought, you would get $2 of ordinary, or you would get a dividend of $2. There's a difference between ordinary dividends and what are known as qualified dividends, and I'm not going to go into too much detail about that, but basically there are certain companies that kind of paid a type of dividend where, since it's already taxed at the corporate level, you don't pay as high of a tax when you pay your personal taxes. But that's a detail you can look up on your own. And typically, your broker will give you a tax form that will outline how much was qualified versus how much was ordinary, based on the stocks that you own with that broker. So you would have a tax statement similar to a W-2, you can say. Okay, then you have IRA distributions, independent retirement account distribution. So this is going to be if you're retired, you have to take certain distributions. So you would add amounts that were taxable here, pensions and annuities, you would have that income, Social Security benefits. And so you would basically, let's say, I'm just going to put some fake numbers here. Okay, so you can see here that, for example, you could have had $5,000 in pension and annuities, but only 4,000 of it was taxable. So again, these calculations, there's some detail on how to do it, and tax law. I'm just putting these in kind of arbitrarily just to give you some idea of how it will be populated. So capital gains or loss. So let's look at what Schedule D is. Basically, a capital gain again is if you own a house, for example, and you bought it for 100,000 and then you sell it for 150,000, you made a capital gain of 50,000 because you had an asset that you bought and then you sold it for more than you bought it for. So it's not quite income in the sense of wages because you didn't do anything to earn it. The market just kind of paid you more than what you bought the original asset for. So it is taxed differently, depending on the type of capital gain it is. And so there's a separate schedule to kind of do those calculations. It's not just a house, it's also stocks. So if you bought a stock for $100 a share and you sold it for $200 a share, you're going to have a gain of $100 per share because it went from 100 to 200. And so it went up per share $100. Okay, so this is Schedule D that was mentioned on the 1040. So I'm not going to go into the details of this, but this basically helps you calculate long-term versus short-term capital gains, which are taxed differently at the federal level. So if you own your house for more than a year, or if you own the stock for more than a year, you pay a lower tax rate on the gain than if you had owned it for less than a year. And so basically, this form will kind of help you determine what your taxable capital gains or losses for both short term and long term. And again, the software will help you fill out all this stuff because it's a pretty involved calculation. You have different things going on here, like section 1250 uncaptured gains. So the software will help you determine what all these numbers on by asking you questions and getting details on all the transactions that you've completed to get to even have the capital gain in the first place. And then we'll populate this schedule automatically based on your responses. Okay, so that is capital gains. Okay, so schedule 1, this is going to have things like alimony, business income. So see, business income, if you are a small business owner, you're going to have business income, and there's another schedule C associated with that, which is profit or loss from a business. So you would fill out this form, you would have your income from your business here, you would have all your expenses like advertising, car and truck, rent. You would then calculate a profit from your small business, and then you would put this into schedule 1. So you see here schedule 1 line 3, you're going to put your taxable income from your small business into this schedule 1 line 3 here. And so you can see, as you keep getting more complex in your tax situation, you're going to just have a bunch of schedules. Here's another one, form 4797. This is other gains or losses. So that's going to have certain situations where you may have other gains or losses. So you can see here that, again, as your tax situation gets more complicated, you're going to have different forms feeding into other forms, which then feed eventually into your form 1040. So you can see here, there's in this schedule 1, you have schedule C feeding into it, this form, schedule F if you have farm income. So there's potentially 3 forms that are going to feed into this schedule 1, which then feeds into 1040. And I bet if we opened up some of these forms, they may have other schedules or forms that feed into them. So it can become very unwieldy. That's why some tax returns are thousands of pages long. Okay, so form 255, again, this is another kind of form if you have foreign income tax exclusions. So if you had a business overseas, you may have some foreign income tax exclusion. And again, the details of this, this is why there are high paid tax attorneys and accountants that know all the details of this stuff, because again, it can get very complicated. Gambling income, so if you gamble and you win, you're gonna have to pay income tax on that, and so on and so forth. Even if you won a medal in the Olympics and got prize money, you'd have to pay taxes on that. So these forms can get complicated based on your situation. Okay, so then we had schedule 1, the total here. Let's say we had some number here. Okay, so if we added this up, this is 21,000, which I got from just adding up what it's telling me to: 1, 2B, 3B, 4B, 5B, 6B, 7, and 8. So I just added all these up and then subtract line 10 from line 9. Sorry, there's 2 different lines in schedule 1. So there's other income from schedule 1 and then adjustments to income. So again, this could have been, if we won $5,000 gambling, that would have been income. This would be 26,000. And then if we had some other adjustment that basically adjusted my income downwards, it would be here. And so when we got our adjusted gross income, so after this adjustment here, it is 23,000, because it's telling me I need to subtract this amount from this amount. Okay, so that's my adjusted gross income, also called AGI. And then it's asking for a standard deduction or itemized deduction from Schedule A. So there's another schedule involved here. If we're itemizing our deduction, And again, refer back to my income tax video to kind of get some more detail on that. But if we look at Schedule A, if you were to itemize your deductions, you would have a couple of big categories here. So medical and dental expenses, taxes you paid. So you have like your property tax, for example, real estate, local taxes. So if you owned a home, interest that you paid on your home mortgage, gifts to charity, casualty and theft losses, other itemized deductions, which is probably pretty complicated. There's probably other stuff you can itemize that you'd have to read the tax code to get all the details on. And so let's say when we added all this up, we had $30,000 of itemized deductions. So if we go back here, and let's say we were filing single, okay? The standard deduction is 12,550, but my itemized deduction was 30,000, okay? So I want to take the bigger number because what a deduction is a reduction in the taxable income that you're going to have. So you're going to start with the AGI, you're going to subtract your deduction, either itemized or standard, and then you're going to come to a taxable income. Okay, let's say I have $30,000 as an itemized deduction because, again, if I put 12,550, which is my standard deduction, I'm going to end up paying a tax because my AGI was higher. But if I itemize, then I'm going to have more deductions and therefore less taxable income, as we're going to see in this calculation. Okay, so charitable contributions, if I took the standard deduction, I did not. I itemized. Add lines 12A and 12B here, so I have 30,000. Qualified business income, let's say it's 0. Add these two up. And then now this is the income that I'm going to pay taxes on. So it says subtract line 14 from line 11. So this is 14, this is line 11. It's going to be a negative 7,000. So it says if 0 or less, then enter 0. So it can't have negative income. So since my deductions exceed my AGI, I'm just going to have 0 taxable income. So I won't end up paying tax. But let's just say I did. Let's say I had $20,000. Let's say this was only 3,000. I'm going to have some tax. And so there's instructions based on this taxable income. There's a chart that will say how much tax I owe. So let's say I owe $2,300. There's going to be items from Schedule 2, which you can look up. It's just, other types of tax credits. So now we're in the realm of tax credits, okay? So the deduction just reduced this amount and basically reduce my taxable income. And then I have a tax. Now we're going to deduct directly from this amount of tax that I owe, which is a credit. So again, if you want to solidify your understanding of the difference between a deduction and a tax credit, again, watch my video on income tax because I do an example and show why tax credits are far more valuable than tax deductions. And so you have all the different types of tax credits. You have a child tax credit. You're going to have the earned income tax credit, which I believe is in one of these forms. And so basically, what it's going to do is get a total amount of tax that you owe. Let's say we had some tax credits of $2,000. It says subtract line 21 from 18. So here's 18. So it's 300. And line add 22 and 23. So 300. Okay, so then this is the amount of tax I actually owe. And then you might have withheld tax. So let's say I withheld on a W-2. So meaning during the year out of my paycheck, my employer had held back money. Let's actually do something different here and explain what a tax refund is. So let's say they had held back 5,000. If you add these up, this is 5,000. Okay, so down here, once you do all these calculations, you're going to see if you are owed a refund or if you have to pay. So you can see here that just to simplify, I owed $300 in tax, but I withheld 5,000. So that's what a tax refund is, because basically I overpaid the government during the year, and now the government has to pay me some of my own money back because they took 5,000 of it during the year. I only actually owed $300 in tax. So a refund is going to be owed to me of 4,700, and you would put your banking details here and they would send you this amount of money back. So when you get a tax refund, you're not actually getting a payment from the government. You're just getting your own money back, which you had basically given to them over the course of the year, and you had overestimated how much tax you're going to owe, basically. And so you're just getting your own money back. If you ended up owing more, so let's say I withheld 5,000, but this was 7,000, then that means that I owe $2,000 in tax instead. So I would have to write a check to the government and pay them an additional $2,000 because I only paid $5,000 during the year. I actually owed 7,000. So now when I file my return, I'll make up the difference. And then you sign here, and it becomes kind of a binding document. You're supposed to represent all the numbers on this return honestly, and so this is kind of what tax fraud is. If you just make up numbers on here, and it turns out that they're fraudulent, you can go to jail for that. It's a crime that they get a lot of illegal organized crime on, because it's hard to prove the actual organized crime, but they're able to prove the tax fraud aspect of it. So, you should obviously uh, put all the numbers in here that are real and honest. Like, don't try to make up extra deductions. Don't underreport your income, because it is actually a federal crime. So once you sign this, you're kind of saying that I attest that all these numbers are fair and are to the best of your knowledge. Okay, and that's kind of a very brief walkthrough of your tax return.